Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Lewis, and I'm excited to share today's top stories with you. We're starting off with a look at the current market sentiment as the Nifty edges closer to uncharted territory. According to Rahul Sharma, a market expert, it's time to be selective and keep an eye on the mid-cap space for the next phase of market leadership. He believes that while the bank Nifty has been leading the show, it appears overheated, with the RSI in the overbought zone. This could be a sign that it's time to take a step back and reassess your investments. Sharma also highlights two mid-cap stocks that he thinks have potential: GMR Airports and KFin Technologies. He recommends buying GMR Airports with a stop loss at 85 and a target of 120, and KFin Tech at current levels with a stop loss at 1110 and a target of 140. Additionally, he sees near-term potential in the IT sector, particularly in Infosys, which he believes could head towards 1600 or 1620. It's worth noting that these are just expert opinions, and it's always important to do your own research and consider your own risk tolerance before making any investment decisions. We'll be keeping a close eye on these developments and bringing you more analysis and insights as the market continues to evolve. In other news, the global market is also experiencing some volatility, with concerns about inflation and interest rates weighing on investor minds. The Federal Reserve's recent decision to keep interest rates steady has had a mixed impact on the market, with some sectors benefiting from the move while others are feeling the pinch. As we navigate these complex market dynamics, it's essential to stay informed and up to date on the latest developments. That's why we're here to bring you the latest news, analysis, and expert insights on the Riskwiser Zone. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're exploring the latest developments in the world of technology and finance. In our previous segment, we discussed the potential risks and rewards of investing in emerging markets. Now, let's dive into a fascinating story about Meta, the social media giant, and its efforts to stay ahead in the artificial intelligence race. It appears that Meta is undergoing some significant changes, with reports of hundreds of layoffs within its AI team. According to sources, around 600 people will be losing their jobs, primarily from the company's Fair AI research lab and product-related AI teams. This move is allegedly aimed at creating a less bureaucratic structure, allowing for more efficient decision-making and increased scope for individual employees. However, this news raises some interesting questions about Meta's strategy in the AI space. On one hand, the company has been investing heavily in AI research and development, with a reported $15 billion spent on acquiring scale and its talent. On the other hand, it seems that Meta is still figuring out how to effectively utilize these resources, with some top talent reportedly leaving the company due to lack of direction. It's also worth noting that Meta's CEO, Mark Zuckerberg, has stated his intention to spend hundreds of billions of dollars on building massive AI data centers for superintelligence. This ambitious project aims to unify the company's AI efforts, but it remains to be seen whether this investment will pay off in the long run. As we consider these developments, it's essential to acknowledge both the potential benefits and risks associated with Meta's AI endeavors. While the company's commitment to innovation is commendable, the layoffs and restructuring raise concerns about the impact on employees and the company's overall direction. To provide some balance, let's also look at the positive side. Cantor Fitzgerald has maintained its overweight rating on Meta stock, citing potential for a sentimental shift in 2026 and improve AI execution. Additionally, Meta has reportedly encouraged affected employees to apply for other open positions within the company, demonstrating a commitment to retaining talent. As we continue to monitor these developments, it's clear that the AI landscape is rapidly evolving, with companies like Meta, Google, and Amazon vying for dominance. While there are risks involved, there are also opportunities for growth and innovation. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We've got an exciting closing segment for you today as we dive into the world of investment-grade bond ETFs and hedge fund-style investments. We're looking at two interesting funds: the PIMCO Active Bond Exchange Traded Fund ETF, or BOND, and the Militia Long-Short Equity ETF, or ORR. Let's start with BOND, which has been a top pick in the investment-grade bond space due to its favorable comparison to its benchmark. However, it's essential to consider that there are even better, cheaper bond ETFs out there. On the other hand, we have ORR, which offers retail investors access to a hedge fund-style, global long-short equity strategy managed by David Orr. The fund has delivered strong performance since its inception in January 2025, with a return of 24%. However, it's crucial to note that its high stated expense ratio of 14.9% is largely an accounting artifact of short selling. Now, let's take a step back and analyze these funds from a neutral perspective. While bond may be a good choice for those seeking investment-grade bond exposure, there are indeed other options available that might offer better value. As for ORR, its performance has been impressive, but investors need to consider the risks associated with hedge fund-style investments and carefully evaluate whether it aligns with their overall investment strategy. In conclusion, when evaluating these funds or any other investment opportunities, it's essential to conduct thorough research, assess your risk tolerance, and consider multiple perspectives before making an informed decision. Remember, investing always involves some level of risk, so it's crucial to approach the market with caution and a well-diversified portfolio. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, invest with caution.